What if your monthly payment could slide down without chasing prices up? This October, the Bank of Canada cut its policy rate to 2.25%. Great, but what does that actually mean for Toronto real estate? Today, I'm breaking down 3 trends to watch for in the rest of 2025 and in 2026 that you can use right now. Sales are ticking up, prices are still calm, and condo inventory is giving buyers a ton of leverage. Plus, why mortgage approval rules still call the shots on your budget, and perhaps even more so than just the down payment alone. When the Bank of Canada makes a rate cut, mortgage pricing often goes down. Buyer confidence improves, and we would expect home prices to go up because of that. And maybe that isn't the case right now, because the real story is in the actual data, so let's get into it. The overnight rate now is at 2.25%. This is the interest rate the Bank of Canada targets for loans between banks, basically the price of money for one day. And so when the Bank of Canada lowers it to 2.25%, the cost to banks to borrow money drops. So prime rates and many variable short-term mortgage rates often come down, making borrowing a bit cheaper. The Bank of Canada mentioned that growth is softer. Canada's economy shrank 1.6% in the spring because exports fell and businesses cut back. US tariffs and trade fights are hurting auto, steel, aluminum, and lumber, so growth is expected to be weak for the rest of the year. It should slowly improve later as consumers spend more and as exports and business investment begins to recover, and we eventually see the housing market go up as well. The bank also mentioned that Canada is adjusting to tariffs. And so when countries fight about tariffs or make tough new trade rules, businesses get nervous and hit pause. In fact, over the last 6 months, the US made changes to tariffs on Canadian goods 3 times. That was in March, June, and August, making costs and plans harder to predict. And that's on top of the fact that it made it difficult for the government and local businesses. It also negatively impacts their confidence, so companies delay spending and hiring, which also means that we see more job cuts. And for now, stuff we buy from other places can cost more, and things Canada sells abroad can sell less. All of this cools the economy, so a rate cut is like a small boost to help keep things moving while the trade stuff sorts itself out. So the bottom line is this: inflation is drifting toward that 2% target, the economy lost steam, and trade headlines are not helping. That's why the Bank of Canada cut for the 2nd time in a row to keep things moving and make borrowing a little easier. The first trend we're seeing is sales creeping up, but prices are still soft, which is kind of a weird GTA real estate market paradox, and here's why. In September, the GTA sold 5,500 homes. That's up 8.5% versus last year. If you smooth out seasonal noise, things like low sales in January and more sales in spring, sales were actually up 2% from August, which puts us at an 8-month high. When we see more sales, it means more real estate transactions are getting done. New listings came in at 19,000, up 3.9% year over year. More choice for buyers usually means less pressure on prices, which means that sellers can't push prices up as easily because buyers have more options and leverage, so prices tend to hold steady, and that's what we're seeing in today's market. The average price landed at just under 1.1 million, down 4.7% compared to just 1 year ago. The estimate, known as the MLS Home Price Index Composite, of what a typical home with average features for the area would sell for, based on recent sales, was down 5.5% year over year, and month over month, the average price was barely up, just 0.2%, basically flat. So what do these 3 statistics mean? It means activity is picking up, but prices are not surging. In early rate cut phases, buyers step out first while prices lag behind until inventory tightens. And October's rate cut helps with monthly payments and buyer confidence, but the amount of housing supply we have is keeping prices flat. This is your window to negotiate now instead of chasing prices in a rising market. And if you need a step-by-step plan for buying in this kind of market, check out this video for a buyer's navigation guide, linked in the description and in the card up top. But now tell me in the comments, are listings still sitting on your street or in your area? Or are showings actually picking up and days on market are coming down? Let me know. The second trend has to do with the condo market, which is all the buzz in the last few years. Tons of inventory, and it's giving buyers a ton of power. Here's why. Condos still have lots of listings across the GTA. 29,000 listings based on the latest Market Watch report. Averages are below last year, and condos are moving slower than freehold residential properties. The October cut helps a bit. Payments may dip and more buyers can qualify for a mortgage. You can also expect days on market to matter. Units sitting 30 or more days are where you'll see the best deals. Small price trims, credits for repairs, and maybe new appliances, and flexible closing dates. So here's what happens. When the Bank of Canada cuts rates, banks also lower their prime rate usually, so variable mortgages tend to drop pretty fast. For fixed rates, the short 1 to 3 year terms can fall more than the 5-year when markets expect more cuts. Yet a small drop in the interest rate can help more buyers qualify, leading to more homes getting sold and the market settles before prices move. And yes, pre-construction homes are still finishing. Lower rates can take some stress off assignment sales. Think of it as building a floor under the market, not launching a rocket. Rate cuts help stop the market from falling by giving it a stronger base, like building that floor, but they don't make prices blast off right away. So it's stability, not a rocket ride. If rates dropped another 25 or 50 basis points by spring, would you look at changing your neighborhood or even your budget? Let me know in the comments, because the third trend that you should be watching for is linked to mortgage rules and upcoming mortgage renewals that might make you think twice. We all know that rates change what you pay each month, but the rules tied to qualifying for a mortgage is what decides whether you're approved and for how much. Canada's banking regulator sets the mortgage stress test and other checks lenders use. So as rates come down, payments get a little easier, and through the 2025 to 2026 renewal wave, each 25 basis point cut takes some pressure off. But it's still the approval rules that decide how far your budget really goes. For buyers, this shows up in two places: the list of mortgage rates a lender is offering today and the qualifying rate your lender tests you at, which is better known as the stress test. The details between each product and lender can be the difference between a yes and a not yet. Keep one eye on the policy rate and one eye on qualification rules. The sweet spot is when both line up. In fact, if you're curious what this means for you and you're in the market to make a move, grab a fresh pre-approval now, then refresh again after lenders reprice the BOC cut. So here's what I would do this week if I'm a first-time home buyer. Lock in a rate so you're protected if lenders move. Start with stale listings, anything sitting 30 to 60 days, because that's where you can pair a clean offer with a flexible closing and get a yes. When you run your numbers, plan with a safety cushion. Use a slightly higher rate in your budget, so good news is a bonus, not a needle thread. Picture a $650,000 one-bedroom plus den with 20% down payment on a 25-year amortization. If your rate slips a quarter to 2/5 of a point after the cut, your payment can drop by around $100 a month, sometimes more, depending on the mortgage. Now add a 2 to 3% price nudge on a listing that's been sitting, and your monthly number feels a lot more chill without moving far from your dream area. If I was a buyer looking to move up, I'd probably consider looking at freeholds in the 905 area, which often heat up first in early recoveries, and they're typically more affordable per square foot than the 416. When you write the offer, try credits for appliances or paint instead of chasing a big price drop. Same net savings, less drama, and if you're selling to buy, price your place where buyers are actually bidding, because at the end of the day, you're trying to attract the most amount of buyers in a buyer's market. And this is among the 29,000 condo listings in the GTA. Let's say you're shopping around the $1.25 million range with a 20% down. A small rate cut helps, but the real magic is in the terms of the offer. Ask for $5,000 or $10,000 in credits towards the other costs, like new appliances or some repairs around the property that need updating. It often beats chasing another $10,000 to $15,000 off in the price and keeps everyone happy at closing. And by the way, if this video is helping and you're gaining value, subscribe for more updates. New videos are coming out all the time. So now this is a fantastic plan of where things could go over the next year, but what if things mess up? More tariffs equals more turbulence. If the US and Canada start arguing about trade again, some businesses may slow down. The Bank of Canada could cut more, but if paychecks get shaky, fewer buyers feel confident. Stubborn prices means sticky rates. If inflation stops cooling, lenders may not lower mortgage rates much. It's kind of like driving with the parking brakes slightly on. You move forward, but everything feels harder and slower. Tougher mortgage rules means smaller approvals. If lenders make approval rules tighter, like a harder stress test, some buyers won't qualify even if rates are lower. It's like a lower ticket price for a roller coaster, but a taller height bar at the gate. But fortunately, the stress test hasn't changed since June 2021. So here's what you can do. Keep a plan A and a plan B. Lock in a rate, leave a monthly budget buffer, and stay flexible on timing. If things change, you're still good to go. The 2.25% cut isn't a buy anything siren. It's a green light to get organized. Better math, better mood, and a short window before the mass crowd of buyers catches on. Watch the 3 trends we talked about today. Sales are up, but prices are still down. Condos with a ton of options and approval rules that still matter, and you'll stay a step ahead. If this video helps, subscribe so so you don't miss the next update, and drop a comment with your biggest question. Thanks for watching, and I'll see you in the next one.